Okay, another market outlook. By the way, this is the last market outlook before I leave. I'll be gone for 2 weeks. So it's Sunday, September 3rd. There'll be none on the 10th and none on the 17th. I will see what kind of internet access I have at the hotels in San Jose, Costa Rica, and in Panama City in Panama. And if I have good connection, I can do some live events. So maybe on Sunday I'll do a live event. On each of the Sundays I'll do a live event. But I don't know what kind of connection I'm going to get. This is also the last week for the big format, meaning that, I put a video up on Sunday that's an hour to an hour and a half. I'm going to switch to doing videos during the course of the week, 10-15 minutes here and there, because sometimes data comes out and I don't say anything about it till Sunday when it's more of a history lesson. I think I could be a little bit more timely when the data comes out. Then I can see the market reaction. We can do a small 10-minute video about what's important in that report and why the market perhaps is doing what the market is doing, which is it's oftentimes a guess. On Friday, we will see here shortly on Friday, I don't know that you could have asked for a better jobs report from the point of view of the Fed and the market, but bonds just didn't like it, and I couldn't figure out why, because it kind of took a rate hike off the table. So sometimes you can look at data and you could say, if we get this data, this is what I expect, and the market will do something completely different, and you're left wondering, what am I missing? What am I missing? Anyways, let's have a look at last week. Last week was a big report for jobs, and I don't know if the jobs numbers could have came in any more perfect for the Fed to not hike anymore. If the Fed is looking for a way out of hiking, this did it. Look at the job openings. Fell to 8.8 million. The previous month was revised down. You can see it's red, was revised down to 9.16 million. The forecast was for 9.4 million for job openings in July, 8.8. The quits rate, the last number we saw was 3.802, 3.549. As employees become less secure about the job market, they're less likely to quit. So a quits rate dropping indicates that employees feel that it's not going to be that easy just to hop over to another job. Well, that is the slack that the Fed is looking for in there. So these two numbers were good, and of course the market did respond well to that. ADP, the always wrong ADP, well, we've got to hand it a red ribbon this week. 177, the actual number was 187. That's about the closest I've seen it. 177. Let's just skip some of the other data. We're just looking for employment data here. Continuing jobless claims up a little bit, 1,725,000 from 1,703,000. Initial claims, not that elevated. The forecast was 235, came in at 228. And finally on Friday, non-farm payrolls 187, below that 200 number. I think the Fed's belief is that you need about 80 to 110,000 jobs, somewhere in that range, every month just for population growth. That's assuming that the unemployment rate won't change, and unemployment won't change, participation rate won't change. It's just with the growing population, that's how many jobs you need to create a month just to handle that. So anything more is still growth. Anything less would be contraction. 187 unemployment rate from 3.5 to 3.8. Average hourly earnings, the forecast was for 0.3, came in at 0.2. Average weekly hours increased to 34.4. And the participation rate, 62.6 to 62.8. That helps explain why the unemployment rate increased when the job creation number was over what the Fed believes would be a neutral number in terms of the unemployment rate. So this is all good. You're seeing the participation rate increase. They want to see that. Weekly hours are strong, which means consumer spending will still be strong. When you combine an increase in weekly hours with an increase in average hourly earnings, that means that consumers are going to the mall with slightly more money. The unemployment rate has increased. Job openings decreased. Quits rates decreased. This is everything the Fed needs to pause. This is the lag effects starting to show up. This, to me, seemed like it would be bullish for bonds. And bonds had a very rough day on Friday, which is, like most things that happen this year, a real head scratcher, because you have to start thinking through, well, why is there a belief that rates would be going higher on this information? And if I had to look for something that day that might have been a catalyst, ISM manufacturing PMI, if we looked down under prices paid, forecast was for 43.9, came in at 48.4, still in contraction, but from 43.9 to 48.4. It is quite common as markets or the economy goes through transition phases, transitioning from a slowdown to a contraction, because that is where most people feel we are, as the slowdown. Whether we're going to get the soft landing and then into an expansion or go into a contraction is still up for debate. But the pathway to a contraction goes through a slowdown, right? On your way to a bad neighborhood, you drive through a good neighborhood. It looks like a good neighborhood, and that has a whole bunch of conflicting signals in there. So that is a conflicting signal happening in the manufacturing sector, because goods inflation seemed to be well under control. And here, it's still under 50, but you're going from 43.9, well, the previous was 42.6 up to 48.4. So if I had to point to something that day, it would have to be the ISM manufacturing. Last week, we also got our second look at GDP. From this, there's our second estimate. We'll get our preliminary look at corporate profits, and coming with the second look in GDP is GDI, gross domestic income. We don't get that in the first look, we get it in the second. So let's go to table 1. Let's scroll down here. Okay, here we are. Here's GDI. We'll leave it up here so we can see the last two lines we're looking for, 2023 Q1 and Q2. So GDI, Q1 was negative 1.8, while GDP was over 2%. In Q2, it was 0.5. Again, while GDP was over 2%. So if we weight the two, the average of GDP and GDI, right here, line 28, for Q1 was 0.1%. For Q2 was 1.3%. Look at GDI here. Q4 of 2022 was negative 3.3. For Q1 of 2023 was negative 1.8. So there is a GDI, a technical GDI recession, while GDP continued to be strong. The average of the two here, 0.1 and 1.3. And this is on a real basis. If you want current dollar measures, they're down here. Here is nominal GDP, 6.1 and 4.1, and GDI, 2.2 and 2.5. This is nominal now. That's not controlling for inflation. This is real. This is really what you want to look at to take the effect of pricing out and just look at the effect of quantity. Average of GDP and GDI, 0.1 and 1.3. A far cry from what our real GDP is showing now. All right, let's have a look at what Treasury yields did week over week. All of them did drop. Had the bond market not reacted as negatively as it did on Friday, if we looked at just up to Thursday, it was a great week for bonds. And then it gave it up on Friday, but still, on the 30-year, still managed to drop at least 1 basis point. Money market rates still well behaved, and the long end of the curve, all rates from the 2-year up to the 30-year, all yields dropping. Curve inversion becoming less inverted, the 2-year dropping 16, the 10-year only dropping 7. That's a curve steepening. Inverted by 69 basis points, 424 days now. And the 3-month to the 10-year 311 days. We are a month and a half away, roughly, almost 2 months from the 1 year anniversary of this inversion. The balance sheet, SOMA, down 14.27 billion, so that is now down to 7.398 trillion. The balance sheet itself down to 8.121 trillion, a drop of 17.75. The SOMA ran off 14, so another net runoff of the Fed balance sheet of 3.48 billion. And money market funds increased 14.37 billion. Retail increased 3.46, a drop in government, but an increase in prime. The one I don't include are the tax exempt ones. So if you're saying, why don't these add up? It's because I just don't include the tax exempt one. Government for institutions, they increased almost 11 billion. Government 10 billion. Prime just a little under $1 billion. This week is a shortened week. Labor Day on Monday. Everything back on Tuesday, and everybody back to school, at least around here. All the grade schools all the way up to high school back on Tuesday, right after Monday. Not a lot of exciting data in the U.S. next week. In fact, there's nothing really in the economic calendar, and I think there's only one earnings report next week, I think, or this week coming up. I think it's Kroger. Adobe is next week. Maybe that reignites the AI story again, but not an exciting week this week. So I think this week is purely sentiment without any data, whether it be earnings or economics, to push the market around. This is just the investor community naked on the beach. Let's see what they do. However, in Canada, we do have an exciting week. Bank of Canada rate decision in 3 days. The expectation is nothing. And I think that is probably the right move, is nothing. The Canadian GDP last reading, negative 0.2. This is for quarter 2. June, negative 0.2 because it comes out monthly. July, we had the preliminary for July, came in at 0. Manufacturing PMI, the last reading was 49.6, came in at 48. Manufacturing in contraction. GDP for Q2, negative. And more stories of consumers having to renew their mortgages at higher rates, having a lot of difficulty. Banks have reported earnings in the last couple of weeks, and we see the loan loss provisions dramatically increasing at these banks. So I think the Bank of Canada has plenty of permission to stay on pause. I think they will. Canada jobs report in 5 days. Here is the performance of the Canadian dollar over the last week. There is Friday morning, and again the labor, the jobs report that came out seemed to give the Fed all the permission to stay on hold, but the U.S. dollar just strengthened against the Canadian significantly, of which I'm okay with because I am heavily in the U.S. at this point. I'm moving my Canadian to U.S. So I don't know why I care anymore, because it's not as if I'm going to bring my US dollars back to Canadian. So I don't know why I care. In fact, I have some Canadian dollars that still have to be converted to US. So maybe I should be cheering for the other way. Maybe I should be saying, oh, come on, raise rates one more time. Tell us you're going to raise rates another 200 basis points. And let's look for some massive strengthening in the Canadian dollar into the end of the year. But I just don't see it happening. In the U.S., there are still some Fed speakers. Wednesday, you have Logan. Thursday, Williams and Bowman. And on Friday, you have Barr. Look at what happened on the probabilities here for the next meeting. No rate hike. Went from 80 to 93. And this, of course, dropped to 7%. This is what I find curious, is the Fed funds futures are basically saying, yeah, I think we're done. Even going into December, the weight of the probabilities have shifted down to the 5.5, meaning less likely there'd be a rate increase. Last week at 5.75, 45.2 dropped to 32. That would seem to be, based on this market, the Fed funds futures market, that would seem to be supportive of bond yields going lower, not higher. So Friday again was one of those curious days that if you tell me what the data was going to be before it came out and ask me what would happen to the dollar to bond yields, I would not have said, oh, bonds are going to sell off hard The US dollar is going to strengthen dramatically. I wouldn't have said that yet. That's what we got. It's been a difficult year for macro because there must be a bunch of micro decisions going on that simply don't add up to the macro. It has to be, because I just don't get it. Effective federal funds rate still sitting at 5.33. We have we have another 3 weeks before the September meeting. Reverse repo, look at this, down to 1.5 trillion now, a drop of 113 billion, 1.5. And our lags still are the same. They're not going to really change until the September meeting. And this is where the weight of the bet is right now, is that nothing will happen. And then, of course, the real story is the press conference. I think they're in an okay situation now to begin to signal, or in their communications, begin to signal to the market that maybe this is all going. They've had more than 1 or 2 data points now. They've had about 3 months of data that suggests that, yeah, these rate hikes have been working. And there are some lag effects that are starting to show up, that this probably, I think, gives them permission to stay right where they are to the end of the year. Sort of mixed on real yields. You have the 5 and the 7 dropping, but the 20 and the 30 increasing. Still an inversion between the 5 and the 10 of 20 basis points. A drop in break-even rates right across the board. Fed funds futures showing a little gumption here. Ending the year December 94.59, implying a rate of 5.41, down from 5.485, drop of 7.5 basis points. Moving into the range here of no rate hike. No rate hike would be in the range of 5.25 to 5.50. Instead of being at the very top end, we're moving more to the middle. Once you get to about 5.375, that is a market saying, I think we stay right here. So we're not far from that now. End of Q1 of 2024, implying a rate of 5.31, down from 5.41, a drop of 10.5 basis points there. And going out to Q2, the end of Q2 of 2024, 4.995. Basically looking at 50 basis points somewhere between now and the end of Q2 2024. It was 5.17, drop of 17.5 basis points. So this is the Fed funds futures market. This is the forward curve on the Fed fund futures. Again, I'm troubled by the move in TLT, which was right here, which seemed at odds with the data that came out. Here is the data that originally came out. You can see the long candle wick where TLT was rising in price, and then snap of a finger, I guess everyone got the email except me that, hey, let's do something completely unexpected. TLT, almost unchanged week over week, negative 0.09. You have to include the dividend if you're calculating the change in price over the week, because there was a dividend over here. There was a dividend. It went ex-dividend that day. So it would have opened 28 cents lower that day because of the dividend. So if you're just looking at price change week over week, it's not enough, because the price change would have included the dividend that you would have gotten. So you have to add the dividend to the closing price to compare it to the closing price last Friday. Don't have to do that next week because there's no dividend. Once you include the dividend, down 0.09. SPY up 2.55%. The August 2048 3% coupon bonds, the ones that I bought a lot of. I made no changes to my positions, by the way. They closed at 78.42. The last ad I did on them was at 76.15. I don't know that I would add to them again unless they got down there again. It just seemed like it had gone too far, and it was just screaming to be bought. That was the right move. Part of me would like to see it continue to drop. I'd like to see these bonds it'd be beautiful. It got to 65. even. Yeah, it would kill my current position, but I got a whole bunch of cash I have to move into treasuries to move across borders. I would love nothing more than to have an absolutely irrational sell-off all week long, like completely irrational, where the Canadian dollar strengthened dramatically and bonds sold off and the universe opened the door really wide for me and said, come on in, buddy, come on in. It hasn't called me buddy in a long time, I'll tell you that. Over 2024, if we look at 1 month SOFR from 2024 in December over 2023, a drop of 94 basis points versus 116 last week. So the market is thinking, when we look at Fed funds futures, is more and more moving towards no more rate hikes. But SOFR, if we look at that market over 2024, is saying, not so much on the rate cuts. This is down to, if you had rate cuts at 25 basis points, suggesting 4 rate cuts. About a quarter ago, that market was suggesting 6 rate cuts. So slowly, they're sort of getting the message. Okay, let's look at mortgages. First, let's just get the boring stuff out of the way. The OAS, really nothing going on here as well. Just is uninterested with anything going on. I think if you're looking for the lowest volatile market out there, it's got to be credit spreads. Just uninterested in anything. Leave me alone, it says. We're doing our own thing. Get away from me. We don't really care anymore. Look at mortgage rates, 7.18%. It has pulled back, down 5. U.S. Treasury dropped 14 basis points over that same period of time. This is only to August 31st. Thursday over Thursday, fixed rate mortgage down 5, so the spread 9. Still, if we look at the mortgage REITs, all of them had a good week. ABR up almost 4%, Annaly 3.3%. Housing just killing it. Let's look at the data from last week. Housing price index for June up 0.3% year over year, as measured by the FHFA. Housing prices are 3.1% higher in June of 23 over June of 22, with mortgage rates some 300 basis points higher. I want you to just digest that for a moment. Case-Shiller, month of June, 0.9, that's month over month. Year over year, only down 1.2%. This uses the 50 large U.S. cities. Last month it was down 1.7% year over year. Now it's down 1.2% year over year. That's it. That's it. Mortgage apps, August 25th. For the week ending August 25th, that's when mortgage rates were hitting the highest, 7.23, up 2.3%. Just doesn't seem to matter. Pending home sales for July down 14%. Look at housing stocks, all of them just knocking it out of the park. Look at Hovnanian. When I checked the price, I said, oh, come on there. I got to check it again. And I had to make sure I had the right stock. Yeah, I do. Up 33%. 33% in 1 week. This is one volatile stock. If you ever watched this one, it's super volatile and no options. That's a stock crime. That's a stock crime right there and should be reported. No options on that. How beautiful would that be if it had options? My God. Up 33%. Toll Brothers, KB Homes, both of them clocking in at 8% gain. I was really hoping the mortgage rate over 7% would have put pressure on them for at least a couple of weeks. But every time they pull back a little bit, they keep roaring right back. I don't think that the market is going to give me DHI under $105. It got to 114, and I'm like, okay, well that's not far to go. It's not far to go to see 105. We get to 105. I'd be interested in adding again, and nope. And Hovnanian, I never think about adding that one. I saw it at 89. Last Friday morning, I think, and I didn't touch it. It ended at 95, and I thought, this thing is too volatile. Look at that. You're just sick about it because it's on your watch list. You've thought about it before, and I changed my mind, and look at it now. IYR up 1.91%, PLD 157, DLR Hitting new highs here, up 4.89. When I say new highs, over the last 52 weeks. I think it's a 52-week high, over $130 now. And before Nvidia started, it was under 100. Nvidia really started the whole rally in DLR because they don't have a very friendly capital structure, and with interest rates where they are, it's not that friendly. So it's the data center story that just keeps on going here. Housing, well, XHB, ITB with housing doing this, that's not surprising. That's not surprising on that one. Housing just keeps killing it. Okay, let's look at S&P, and then we're going to spend some time on the equation I presented last week, Grinold-Kroner, on forecasting expected returns on each of the variables here. From earnings so far, they're, I think, mostly done. I think there's one or two companies left to report in the S&P 500, but they're mostly done. EPS came in 7.9% above the expectation going into earnings. Revenues came in 1.7% above the expectation. Year over year for Q2, EPS growth year over year was down 2.9%. Yes, we did beat lowered expectations by 7.9%, but it did not beat last year. Came in at negative 2.9%. Came in at positive 3.5% if you exclude energy. But the S&P 500 has the energy sector in there, so it's negative 2.9. The expectation for EPS growth in Q3 is 1.8% year over year, 7.3% if you exclude energy. Forward 4-quarter operating earnings, S&P Global has it at 231.04, IBES has it at 233.40. Take the average of the two, closing SPX gives us a forward multiple of 19.44. At the, I think, strong end of the range, if you take the earnings yield on that, it is below what a 1-year Treasury will offer. And in fact, if you compare it against a long bond, because when we think about CAPM, the risk-free rate, if we're using the 20-year bond, you compare it against a 20-year bond and give a beta of 1 to the S&P 500, calculate what the equity risk premium would be in that. It's like 66 basis points. That's the equity risk premium. You can get 5.5% in a 6-month Treasury, or for 66 basis points of potential gain of risk premium, you can go into stocks and see if you can do better. 66 points. And that's not even versus the 6-month Treasury, that's versus the 20-year. IVP dropping, 13-week down to 19% from 78%, so volatility is coming out. IV last was 10.772. Last week, the market was strong, so I said I would sell calls, and I did. December 4,600 at 95. I've sold some there. December 4,650 at 93. So as it was moving up, I sold the 4,600 at 95. I let it move up. I then moved up to the 4,650. I was getting 93. I have them now in a 4-to-1 ratio. So I have 4 of these for every one of these that I have. And these are positive, and these are negative as we end the week. Okay, let's revisit the 2 models we looked at last week. The first one was for giving us some forecast for real GDP growth. We can get that from real inputs, growth in labor inputs, and growth in labor productivity. So more people working, and of the people working, producing more output. Latest numbers for labor productivity come from Q2 2023, 3.7%. You only get this after the quarter is done. So the next number, the quarter ends September 30th. It comes out like 1 month later. So we can look for like November 1st, November 2nd to get productivity for the third quarter. But all we have now is second quarter. That 3.7 is annualized, 3.7% annualized. So that's a starting point. You'll notice a purple star here, and I give you a small legend here. Wherever you see that purple star, That's where the risk in our forecast is. I don't say there's too much risk over here. This is labor force. This is from a Friday's jobs report. This is labor force growth, August 22 to August 23, went from 264 to 267 over the last 12 months. LTM increased 1.15%, and that's not by physical count. That's just implied. There's just a linear function in there implying that. So we can extrapolate that forward for the next year. I don't think we're going to be very far off on that, 1.15. And I'm going to put 0% growth on the participation rate. That gets us to 4.85 over the next 12 months. Again, the risk of our forecast is heavily skewed towards our estimate of labor productivity. GDPNow for third quarter is at 5.6%. If we look at the combination of GDP and GDI for Q1 and Q2, you're 0.1 and 1.3. So this naive extrapolation here is 4.85, GDPNow 5.6, but so diametrically different than what we have here. But, you know, this is where we are. So November, when we get the next look at productivity, we can update this. And then every month we get a jobs report, so we can see what the last 12 months of labor force growth was. Should hug very close to 1.15. You might have some risk in participation rate. It went to 62.8 from 62.6. So that is 0.2 difference. If you calculate a percentage on that, that might be 0.32%. So if this is off, it might be off by 0.3%. If we expect participation rate to continue to grow at that rate, you know, 62.6 to 62.8 would have to go to 63, 63.2, 63.4 over the course of the next year. Let's look at Grenoble Kroner. Here, this is a short-term forecast expected return, and we're just going to assume next 12 months. So you'll get a dividend yield, and there are share buybacks. At the level of the S&P 500, it's rare that you have a lot of share issuance. Not that you don't. Some sectors do. REITs are known for share issuance, and utilities are known for share issuance as well. So you do have shares being issued in the S&P 500 if you include all the sectors, but you also have share buybacks announced. I think it's a total of 3.5–4%. If you took all of the share buybacks and all the companies who announced share buybacks used it all in the next year, it's something like 3.5–4% of all shares would be bought back. But you do have share issuance, again, coming from utilities and REITs, and it's very rare that a company would use its entire buyback in 4 quarters. So I put 1% for share buybacks, that the share count across all the S&P 500 companies would decrease by 1%. I think that's a fair estimate. I don't see a lot of risk there. I don't see a lot of risk in the forecast of the dividend yield. Your risk comes in the capital components, the percentage change in earnings and the percentage change in PE. So the combination of these two is 2.7%. So does the change in capital add to it or subtract from it? For change in earnings, what are we going to use? If we look at Q2 corporate profits year over year, it was negative 0.4. If we look at the estimate for Q3 earnings year over year, it's 1.8. And since we are looking at a forecast on the S&P, would we use a forecast on the S&P itself, or would we use the broad measure of corporate growth in the economy as a whole? That's something for you to decide. But if we use the 0.4, we get to 2.3. By adding these up, if we use the 1.8, we get to 4.5. And that is up to this point in the equation. It's the change in PE. 19.44 times right now. Every 1 point change in the PE is 5.1%. So if it goes to 20.44, it adds 5.1% to the return. If it drops to 18.44, it takes 5.1% away from the return. So I made this simplifying assumption here that if we actually see negative change in earnings, that the PE would probably drift to 18 from 19.44, which would then make the entire return negative 5.6%, and there would be a price target, 12-month price target on that. And if it were more to the higher end, if we had the 1.8%, then maybe you could get an earnings, a multiple expansion up to 21, which would be 10.11% on the upside. 49.71, 12-month target. However, here's the problem I have with this one here. If you take the earnings yield, you're 5.14%. A 1-year Treasury is 5.36. A 6-month Treasury is 6.47. The 3-month is 5.53. The 20-year is 4.48. So if we're thinking about what this implies for the equity risk premium, remember CAPM, right? The return on equity will equal the risk-free rate plus beta times the ERP. Well, if we're getting an earnings yield of 5.14 and a risk-free rate of 4.48, and we assume a beta of 1, you have an equity risk premium has to be 66 basis points, which is really tiny in terms of what that should be. You're not getting paid a lot to go from a distribution that has no price risk, really, if you hold it to maturity, versus significant price risk. Even if you want to get out of duration altogether, look at the 3-month, 5.53, with zero distribution, by the way, around that return. Zero distribution, or 5.14 with a distribution. Kind of hard to justify a PE at 19.44 when you're competing with Treasury yields at these levels. Now, if Treasury yields were sub 1%, let's say T-bills were still sitting at 0.2, 0.3%, the 20-year was sitting at 2.1%, then I would say, well, yeah, 19.44 may be justified on a competition basis for investment based on where Treasury yields are. But at these levels, to also have such a low earnings yield on the S&P on your risky assets, when your risk-free assets are sitting at these levels, I would seem to think that there was more downside risk on this component of Grinnell Kroner than there was any upside movement. So let's look at my notes over here. As inflation drops, the market seems to be more excited about a Fed pause and maybe even some Fed cuts coming up, and it's supporting equity prices with that. But keep in mind, as inflation drops, that means revenue growth is dropping as well, because revenues are not real, they're nominal. So you're selling a nominal dollar. So if inflation fades away, that means that prices aren't rising. And if prices aren't rising, that means revenues are not really rising, right? So if you don't have that revenue growth, if revenue growth is going to be low, I'm not sure that your percentage change in earnings will be near the higher end of the range. So I'm giving the dividend yield. Yeah, that's pretty much in the books. You can count on the dividend yield, 1.7. I think share repurchases continue on. Unless you get a major crash in the economy, I think it continues on. A major crash, companies would pull their share repurchases because they would conserve cash on the balance sheet. And probably more companies would rush to issue equity, especially in the REIT sector. But I'm not considering that scenario. I'll just say, okay, I think 1% is sufficient. For earnings, the percentage change in earnings growth, I got it negative 5.5%. And how I'm getting there is I'm saying, well, 215 over the next 12 months, and the combination of both S&P and IBES is 232. So just a drop from 232 to 215, and this 32 represented a 1.8% gain to begin with. So figure out what the percentage difference is, subtract the 1.8, you get 5.5%. And the change in the PE, negative 10.2%, I think it goes from 1944. If you have a scenario where earnings are down to 215, I think that justifies only a 17.5 multiple which is still above the long-term average, by the way, not a 19.5, but a 17.5, especially given my alternative of where I can go and the yield that I can get. And if I want to get an even slightly better yield, I can go into investment grade. Investment grade has shown no fear at all. Credit spreads are showing no fear. I can get another, just on the investment grade category, another 120, 130 basis points on top of that on a yield. So I'm sitting higher in the capital structure than equity is by sitting in investment grade corporate bonds. And you know, the 1 year sitting at 5.36, I could be pushing somewhere around 6 to 6.5%, sitting higher in the capital structure without any equity risk at all, right? So it's hard to go into this thing at 19.44. So I got it down at 17.5. If you take the combination of this expected return, negative 13%, brings you down to 39.28. Which really, when I look at that number, I think, yeah, if I had to draw lines on a chart, I probably would have drawn it around 3,900. And even before the dumb rally from 3,900 to 4,600, because I think we got to about 4,600 on the S&P, 4,550, 4,600. Even before the dumb rally, I thought it was fairly priced between 3,800 and 4,000. I still think that. Because of this competition over here, I still think that. So even going through this, you know, the analysis, I get to 39.20. I think, yeah, that feels about right. Anyways, the point here of all of this is this over here is a nice way to think about where your return is going to come from. You say, well, I think the market is going to go up by a certain amount. I think, okay, 10%. Well, where does it come from? Right? There's something that's going to come from your dividend yield. There's something that's going to come from the amount of shares either increasing or decreasing. You're going to have to make a decision on that. And your two biggest risks is, well, what's going to happen to earnings? And do we have multiple expansion or multiple contraction? If you have earnings expanding, you can justify a multiple expansion. If you have earnings dropping, it's hard to say at these levels, given these yields in risk-free assets, that you would see multiple expansion. It would just be hard to see. However, this market has done some very odd things this year. Right now, this situation, I feel, is a very odd situation when your implied equity risk premium is sitting at 66 basis points. It is, this is macro, by the way, is big models, top-down models, not so much looking at the valuation of each company and adding them up, but, you know, very top-down, looking at big trends like this. Macro just has not worked out well this year. So for those of you thinking, oh, this is a waste of time, you might be right, because it hasn't worked out well at all. I think the market right now is more behavioral than it is fundamental. So when it is more behavioral, spend all the time you want on the fundamentals, it probably won't matter. Next week, or this week coming up, is a nice test of that behavioralism, because there really is nothing significant on the fundamental side coming out, but that doesn't mean there can't be. That doesn't mean you wake up one morning and you find out that there was a significant bankruptcy or a failure of something somewhere that was unexpected. That's something fundamental that could change everything, but going on its own steam. All it has to go on is the data we already know, nothing really significant coming out, no real great earnings of any note, only one company. Let's see what behavioralism does for the week. And that will wrap it up here, because it is Sunday. I am flying out on Monday, and I've got a pile of things that have to get done today. I have somebody staying at my house for the next 2 weeks as a security guard because, well, you know, I am nervous like that. And then when I come back, we'll have shorter videos more often. While I'm away, I'll see what kind of internet connection I have, and if it's a good one, I'll do a couple of live streams. Until then, have fun.